Hey everyone, John and Ray here, slingshotfutures.com. Today we're going to be talking about standard deviations and how to calculate them. Now, for whatever reason, it's extremely difficult to find a tutorial online that goes over actually calculating your own standard deviations. A lot of people sell indicators and all this other garbage that actually does the math for you, which I guess garbage is the wrong term. It does take a good amount of legwork to get the numbers and all of that, but once it's done and once you understand how to do it, it's really easy. You just drop some horizontal lines on the chart and bingo bango, you're ready to go. So, one of the big things, whenever I see a situation like that where something just isn't covered, I'm a big fan of filling in that void. And this is going to be one of those. Now, a standard deviation, by its definition, okay, is a quantity calculated to indicate the extent of a deviation from a group as a whole. So what does that mean, right? Well, what that means is that generally speaking, you're going to have the average that falls inside of here, right? This is kind of the average. But there will be those outliers that sometimes come out here and go out there, and these would be deviations away from the mean, right? These are instances that were beyond the norm that happens. Now, in this case, we're talking about markets, so in this standard deviation calculation, we can look at a deviation away from the typical amount of movement in a day. So if we can get the past year worth of data in terms of the closing prices and how much they moved in comparison to the previous day's closing price, that's all we need, right? That's all we need to calculate a standard deviation. Now we can go one step further and calculate an upward deviation and a downward deviation. Sometimes you can calculate them, one side and just assume that the other side is the same, but that's not always the case. Sometimes, as we all know, markets fall faster than they rise, and that usually means that markets tend to have a larger down day over an extended amount of time than they do an up day. Now, I'll show you what I mean by that, but the reason why I calculate them separately is because I want to know what the average is of up days, and I want to know what the average is of down days, so we have kind of a double standard deviation, if you will. So this double standard deviation is really what we're going to look at when we're talking about standard deviations, and just so you can get an idea of another visual representation of this. This is from good old Google Images, and this is exactly what I'm talking about. Generally speaking, markets will close within this band, right? And now downside or upside is 34.1%. You add those two together, you get 68.2%. So 68.2% of the time, the market is going to stay within a band of one deviation. Now, there will be times where the market goes outside of that, and that's what we have here. On top of that percentage that we just talked about, going further down to a -2 deviation is significantly less than the overall, in the sense of significantly less, meaning that it goes beyond that by just staying inside of these standard deviation bands. So if we do these calculations, right, if we look at the math, and again, I know the math is fairly easy, but it's nice to do it on screen so you can see it. 34.1 plus 34.1 is 68.2%. So 68.2% of the time the market will stay within a one deviation band. But there are those times that the market does what it wants to do and goes absolutely crazy, so we can add to that plus 13.6 plus 13.6. It's 95.4% of the time the market will stay within a two deviation band. Now you can even split this up a little bit further and say, okay, well, what about half deviations, right? So a 1.5, a 2.5, a half deviation, etc. A 1.5 deviation is roughly around 80%. 2.5, you get the idea. It's bigger and bigger and bigger in terms of the probability that the market stays within that set amount of range. Now, if we go even further out and say 3 standard deviations, which almost never happens, plus 2.1 plus 2.1, it is 99.6% of the time the market will stay within 3 standard deviations. If it goes outside of that, then it's a blockbuster day and something's going crazy, or whatever's happening. But if it goes outside of that, chances are it's going to come right back inside of that 3 deviations, and if it doesn't, you might have one heck of a move on your hands. So now that we know the probabilities and the percentages behind it, we can go a little bit further. Now, we can do these calculations manually if you would like to, but again, trying to make things as easy as possible, I just use Google Sheets. Google Sheets has a really cool feature built into it that we can use. Now, I'm not 100% sure if this is a feature on other things, like Excel or any of those, but I know Google obviously has Google Sheets, so, if that makes any sense, well, then we should be able to just use Google as our reference, right? So what we're looking at is up here. And this is the important calculation that we need. Equals Google Finance. So what it means is it's pulling data from Google Finance. Here, we're giving it a ticker symbol, so in this case, AMZN, Amazon. comma, close, because we want the closing prices. And then what we want it to do is we want to plot it 365 days back from today. So we take today, in parentheses, basically a 0 parenthesis, minus 365. We want it to plot backward 365 days up to today, right? That's all we're telling it to do. So that's a calculation if you're looking for it, but you put that in box number 1, equals Google Finance, parentheses, in quotes, AMZN, or whatever ticker symbol you want, comma, in parentheses, close, because we want the closing price, comma, today, minus 365 days, because we want a year worth of data, and we want it to accumulate all the way until today, right? There's your up to today. That's the calculation. And by doing that calculation, it's going to automatically fill in all of this stuff for you. It's going to do everything that you need in terms of finding all the closing prices, 365 days worth of closing prices. Now, what we need to know to find the standard deviations is what the change is from day 1 to day 2. How much did it move up or down? And that's where we use the next calculation, which is ln B3 divided by B2, right? So essentially, you're just looking at B3, the closing price of today divided by the closing price of yesterday. That difference will give you 0.47%. So it's a very simple calculation, equals ln in parentheses B3 divided by B2. Now, what we want to do is we just want to basically drag and recreate that all the way down. So it's a rolling calculation. So this one would be B4 to B3, B5 to B4, B6 to B5. You get the idea, all the way down. And that leads us to 365 days if we go all the way down to here. Now, the reason that I have a couple extra calculations in here is because, well, I don't want to have to deal with doing all the math. I want it to do it for me. Let me zoom this out a little bit here. There we go. So this is looking at the largest up day versus the largest down day, which is essentially just saying equals max of C colon C. That's the entire C row. What is the furthest up that it went? And then we also want the min, which is equals min C colon C, which is the entire C column. The lowest that it went, right? So the farthest, biggest move that it had down versus the biggest move that it had up. And this is what I was talking about. Largest up day on Amazon over the past year is 6.85%. The largest down day is 8.14%. Fear causes larger moves, and we see that on pretty much everything. It doesn't matter what you type in here. If we set this, instead of AMZN, let's look at Ford, right? Symbol F. If we look at Ford, it will auto-populate everything for us. We'll go down 365 days, and we can see the largest up day in this case is actually reverse. Largest up day is 9.44%. Largest down day is negative 7.28. So sometimes you do get those types of moves, but generally speaking, the largest down day will be bigger than the largest up day. Let's go back to Amazon just so we keep it consistent here. So let's go down. Now, the calculation boxes that I have over here are to make life simplistic, right? 0.5 deviation, 1 deviation, 1.5, 2, 2.5, and 3. We know that if it goes outside of 3, something crazy is going on, and I probably don't want to have to mess with it. But, you know, you can add more deviations if you would like. The chances of them hitting are extraordinarily small, but you can have them if you want. Now, what we want to calculate is the upper deviation and the lower deviation. What I mean by that is the largest up days and the largest down days, taking all of the up days and looking for standard deviations off of the up days, and then taking all of the down days and looking for standard deviations off of the down days. And again, the reason I do that is to create a double standard deviation so that we have the fairest deviations possible to the upside and to the downside. A lot of people don't do that, and they specifically just look at standard deviation. Well, if up is $1.17, then the down should be $1.17, and that's not the case. Now, this is a really good example. If we just look at the first calculation here, half deviation, the upper versus the lower, there's almost $1 plus difference here, right? $14.17 versus $15.60. That's a big difference, right? And this is why I calculate them separately. Now, I know the numbers look kind of weird. Upper isn't a negative and lower, but just bear with me. It'll all make sense in a minute. So first of all, we want the upper. And what we need to do here is figure out the deviation size that we want so that we know the calculation, right? So in this case, 0.5 deviation is what we're looking for. Okay, now that we know that we are looking for a 0.5 deviation, we're looking to calculate the upper deviation. So we want to go in here and we want to say equals average. Let me zoom in here. A little too close. Equals the average of C. So the entire C column minus 0.5, right, a half deviation, minus 0.5 times standard deviation of C. And what that's basically saying is give me a standard deviation of 0.5 over the entirety of the column of C. And because we're minusing 0.5, that's where we're getting the upper and lower numbers, right? Now that's why, because we're minusing 0.5, we are getting a negative number here. That is a negative 1.05%. So now that we know that, if we were to go to the other end of things, the lower, what do we get? Well, we get a plus, right? That's the only difference in the calculation. Equals average C colon C plus 0.5 times standard deviation of C. That's it, right? That's the only difference between this one and this one is a plus versus a minus. Now, all we have to do to change the deviation size is we change the calculation to the number that we want, right? So average, if we want a 1 standard deviation, is minus 1 or plus 1. If we want a 1.5, we do a 1.5. And if we wanted a 1.738, you could do that in there too. That's the cool thing about this calculation. It's really, really open. So you can type in whatever deviation you want. You could even throw a fib number in there if you wanted to and see what it wants to do, right? 1.618, give me a Fibonacci deviation. And that will do it for you, right? It'll calculate everything. So you need to create a bracket for the upper, which is minusing, again, minus 0.51, 1.52, 2.5, and 3. And do those all as separate calculations. And we want to do the opposite for lower, so plus, right? Plus 0.5, 1, 1.5, you get the idea. Now for the upper, right here, this section, this is actually giving us the dollar value. So if we take E 246, in this case, if we look down here, this is column E. And we have 246 right there, right? So we're looking at this calculation and it's referencing this right here, right? So it's taking E246 times B252. Well, here's the B column and here's 252. What's it doing? It's timesing it by the most recent closing price. That gives us an actual dollar value, right? So a half deviation of 1.05%, okay, cool, but that doesn't help me if I'm trying to manually plot these lines. I need a dollar value. And that dollar value in this case is negative $14.17. You want to do the exact same thing for the other end, except in this case, we want to take F246 because, again, we're looking at the F246 timesing B252. So we're just shifting the calculation. This column, actually, let me do it this way. This column references this column. And if we switch this over to red, this column references this column, right? That's the only difference here. Now that we've calculated the dollar value, right? The dollar value, we can then essentially add or subtract that to the last closing price, and we have our standard deviations. Piece of cake, right? So now that we know that the upper deviation is $14.17, we simply take this calculation, right? So in this box, we take B252, which, as we just talked about, is the most recent closing price, and we minus G246. Now, the reason we minus it is because this is the upper. This is a negative number. Minus minus equals a plus, right? So essentially, we're taking 1358.13 plus 1417. That's all we're doing. And that gives us the upper price. So in this case, half deviation on Amazon today, at the time of recording this, is $13.58 And we follow this calculation all the way down. So if we were looking at the second one, the full deviation, we take B252 minus G247, right? G247, so again, draw the lines on there, G247 right there. So we're minusing we're minusing a negative, right? So we're adding 29.05, which would be 1373.01. You just do that all the way down. For the lower price, it's a slightly different calculation, but all is essentially the same. We're just minusing it. So B252, again, the most recent closing price, minus H246. H246, right? So we're referencing the lower price, and we're taking the lower price over here. So we're taking $1343.96 minus $15.60 equals $1328.36. It's the exact same calculation all the way down, just for different deviations. And that's all you got to do, right? Now, if you want a standard deviation of something, literally all you have to do is click on box and column number 1 and change the ticker symbol. So if I wanted the S&P, right? If I wanted the SPY standard deviations for today, I simply replace the AMZN in that calculation with SPY, hit enter, scroll back down again, and all of the calculations are done for me. Everything is done. So now all I have to do is literally take these numbers, draw a horizontal line on my chart, set it to the correct price, bingo, bango, boom, bam, we're done. Right? All the standard deviations are taken care of. Now, as you can see, having to manually type in each and every single deviation line can be a little bit tedious, which is why people make indicators to do this. But I just want you to understand what the indicator is actually doing. It's not complicated at all, and it might save you a couple $100 knowing how to do this and just doing it manually. The cool thing about this is you will know the closing price every single day after it settles, usually by 6 or 7 o'clock at night. Eastern time, of course. So you could easily plot these on the chart the day before, and you'll be ready to rock and roll for the next day. You won't even have to mess with it, right? Right before you go to bed, just load up a standard deviation, take 20 minutes or so, plot them all on your favorite markets, boom, you're done. Go to bed, you wake up, ready to rock and roll, everything's done for you. So that's what standard deviations are. It's very simplistic. Don't get caught up in the hype of having to buy all this garbage that you don't really need. It does save a decent amount of legwork, but once you make this spreadsheet, what else do you need? It's pretty easy, right? So that's going to do it for this one. Hopefully you found it useful, interesting, entertaining, and something you probably want to add to your tool belt. Standard deviations can be extremely powerful, and knowing how to calculate them, oh, that's another step that a lot of people don't like covering because they want to sell you an indicator. So that's going to do it for this one. Again, I hope you found it useful, interesting, something you can add to your tool belt. As always, underneath the video, click on the thumbs up button to show us you like the content. Next to that, click on subscribe and click the notification bell icon to the right of the subscribe button so you don't miss anything important like one of these videos that could very well have saved you a couple $100 on an indicator. That's going to do it. As always, I hope you had a phenomenal trading day, and we will see you all in the next one. Thanks.